please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
A huge equity market rally, GST, RERA, the US tax changes, the Bitcoin madness, state elections, politics and whatnot. Yes, it is that time of the year. Another 12 months have simply crossed us by. Can you believe it? Yes, 2017 is drawing to a close. Now, if you systematically simply kept your head down and continued investing in mutual funds, then perhaps you would be a very happy person today. Well, it's a good time, as always, to reflect back at the last year and, more importantly, to look forward at trends that might shape your and my wealth, our personal finances in 2018. So we decided to get out of the studios for a change, and here we are at Kama Lounge in Kamla Mills in Mumbai. And we've got some of our old money friends, as always, joining in exactly a year later. Of course, you've heard them during the course of the year as well. But exactly a year later, we are once again back with Feroze Azeez and Harshvardhan Roongta to discuss all the trends that could shape our lives, our finances in 2018. Gentlemen, great to have you back. It's deja vu. It's 1 year and it's flown by really fast. And I must say, I was going through that old episode, Feroze, and you did say, and I must put this on record, that equity is going to be the asset class of 2017. And that's how it really played out. Your first thoughts?
Yes. See, sometimes you're very fortunate in life to be able to have writing on the wall. Exactly a year back, it was times of demonetization and stuff where there was pessimism built in. There was a lot of good stuff from an economic standpoint which was not priced in. Unlike in debt, sometimes markets go ahead or sometimes they lag behind. And so it was very crystal clear as why I'd recommended 100% allocation to equity and on a radical thought. So that's not the situation today. But I think there are signs which you can read and make sure from a personal finance perspective. The most important thing is asset allocation. And if you're able to get your asset allocation right and review it every year, which is what we're doing now, I think that's a wonderful thing to do.
Absolutely. Harsh, how do you feel looking back at 2017? How's the year been?
Well, we've seen the good numbers. We've seen the inflows into mutual funds, especially the equity schemes.
Oh, yes.
The number of folios increasing to almost about 6.5 crores now. So this is a very positive trend. We look at the performance, the index has given about a 26%. That's a large cap. The mid caps have been about 35% returns, it's been about the last year. Well, what's important is, when we've seen the inflow of money, the kind of money that is coming into mutual funds today, it's kind of scary now. Because, now we're seeing the returns, the markets going up purely driven by liquidity. Now, with what happens with liquidity-driven, rallies is that once the money starts going out, it goes out in the same flow. So now, going further, do we see a repeat of 2017? I doubt so.
The proverbial correction, and we don't know what that word means anymore, do we, Feroze? Does that worry you, the point that Harsh raised? The fact that it's been a uniform one-way move, and almost everybody, especially retail investors who are getting in now, believe that this is an asset class which just goes one way, and that's up.
See, it doesn't worry me.
Okay.
Because if you have solutions to your problems, then it's lesser of a worry. Now, what are the solutions we have to a situation like this is point two. Point one, like Harsh rightly pointed out, it's been a liquidity-driven rally. The fundamentals haven't caught up. But the important part to see is, what is this liquidity? Where is it coming from? Is there a dramatic difference between the liquidity coming in the past to today? Point one is this liquidity is domestic liquidity. Point two, it is sticky liquidity. This is not a person putting 10 crores and that aggregating to 6,000 crores of per month liquidity.
Sure.
It is a person investing 2,000, 3,000, 4,000 rupees a month, which is SIP liquidity of $1 billion a month, is significantly more than FIIs have pumped in the decades to come, right? Or in the past.
Yeah.
I think liquidity might not dry up. I was speaking to a few CEOs of mutual fund firms. They're targeting a 3 billion SIP book in the next 3 years per month, and it's practically possible because 98% of the people are outside.
Sure.
So liquidity can continue to come, and at least in the research which we did, we realized that when domestic liquidity comes, mid-cap stocks run up more than the large caps and FI.
Sure.
So it doesn't
So
bother
have
me.
more mid-cap funds in your portfolio than large caps this year?
So maybe from a strategy standpoint, I think that could be. But I think if we dwell deep into it, I think the holistic strategy being drawn up for 2018 is far more critical.
Oh, absolutely, because we do have the top 5 funds We've, really forced Harsh and Feroze to sit down and dig out the best 5 funds that perhaps could be, great wealth creators in 2018. That's coming up in just a bit. But another trend, that was very, very apparent this year was the shift to financial instruments rather than physical instruments. As Indians, we've always loved real estate, we've loved gold, but the numbers that we've just discussed was a year when people realized that it's probably easier and simpler to make money by investing in mutual funds. Is that trend going to continue, you think, Harsh?
Yeah, absolutely. Because, we've seen, people have understood the importance of financial assets, the liquidity that a financial asset offers in comparison to a real estate. Real estate has been a bad run in the entire 2017. So there is going to be some kind of inclination towards financial assets. We've seen, of course, it, going well with the returns that the financial assets have also given. So now we will see 2018 also giving a lot of, importance to financial assets, now within which it is important that you have a proper allocation.
Oh, absolutely.
You cannot, just go about looking at the past returns that last 2 or 3 years have been a one-way street. Sure. So you cannot have all your money going into markets going further. We are telling you where the money could be flowing in 2018. Still in conversation with Harshvardhan Roongta as well as Feroze Azeez. So Feroze, I'm going to ask you the same question. You said that asset allocation is going to be the key. While that will vary depending on individual goals, life goals, age profile, etc., largely speaking, 2018 will be again a year of equity. Do you think real estate can make a resurgence? Where will the money be made?
See, in my opinion, real estate is going through a transformational structural change. And even if there's money to be made, would I want to be a party to it? Why do I say that? Because the cash generation in the economy is significantly lower today and it's trending downwards. That's a big change of how we have seen real estate in our lives. Second is it has been unregulated for years and centuries maybe, and now it is being regulated, right? Then you also have income tax, which is changing the rules for a builder's stock. So in this kind of transformational structural change in the asset, would I want to be a part of residential real estate in metros? The answer is a big no. Okay.
Because there are a lot of people willing to, or trying to pick the bottom, so to speak, over there, that 5 years underperformance, 4 years, maybe the tide will turn now. So you don't see that turn happening in 2018?
I don't see the tide turning, because it will only be academic tide turn, because people don't sell, but they perceive their value to be higher, then it is actually sellable. So booms are also not realizable. Bear runs are also not realizable. So the price discovery is so inefficient that you're not able to sell the stock, and there's no comparable stock to compare it against. So real estate is a no-no in my opinion. Where will the money be made? Of course, I personally think that equity will be the place where money will be made in 2018 as well. And on the debt side, and I very strongly feel that if the yields harden further by another 40-50 points, then there is going to be money made in the debt space, because largely the trend is interest will go down, like Harsh mentioned. But the short-term blip of this yields
hardening, and that's been the phenomena in the last 4-5 weeks. We've seen that, and everybody is talking about how you're not getting anything on FDs, but the 10-year benchmark yield has moved up substantially.
So if there's a 40 paisa move, that is 7.5 on the yield, if I have to be more specific in the recommendation, it's a good opportunity to have debt making you in this year 9.5% return.
9.5%
if the yields went to 7.5.
Okay.
And if you were agile enough to realize that and track that variable, because debt becomes a large component of one's portfolio. Okay. So that kind of agility and vigilance is very, very important on the debt portion, because it's not 10% of your portfolio. It might, in Indian's case, it's almost like 70-80% of portfolio.
Absolutely. Which is why I'm going to come back on the debt point, because we need to know then which debt funds to be in if there is money to be made there as well. But Harsh, your thoughts quickly again on the asset class, mix, and which asset classes you think you would want to back this year?
So, well, equity, of course, will be a portion of your portfolio. Within equity, I'm more inclined towards recommending a large cap oriented portfolio.
Okay.
With a simple reason, we've seen a huge rally in the mid cap segment, in the small cap. Now, we've also seen and interacted with fund managers to understand what is their outlook on the mid cap space particularly. As a result, we've seen, a lot of funds have actually reduced and restricted the inflows that you can now make into mid caps, because they're running out of ideas. Now, the question is, if I were to invest into equities, where would I want to park my money? Where would I feel comfortable given the environment that I am in? So my bet would be on large caps, the companies which are well established, the dominant positions, the cash rich. If at all there was a turnaround in the market, I'm going to see which company is likely to be able to bear and handle that kind of a crash in the markets.
Okay, fair enough. So I'm going to quickly go over the fund list that Harsh has recommended. 5 funds as we promised, top 5 from both our guests today. So the first one is actually an ETF. This is really interesting. You're going with a plain vanilla Hdfc Nifty ETF.
That's correct.
Okay. The second one is the ICICI Value Discovery Fund. Largely it's sort of a large cap oriented fund,
Absolutely.
right? I checked the returns, so we're talking about 19% in the last 1 year, which means it's actually underperformed
That's correct.
a couple of its large cap peers. Then why would you go for this fund?
So ideally, if you look at the investment philosophy of ICICI and Naren as a fund manager particularly, he's been very conscious about the valuation parts. So he's not gone with the euphoria in the markets, and he's just not picked up anything that has potential for a growth.
Okay.
So there is, as the name suggests, is value discovery.
Sure.
So the idea is that you will want to invest into into companies which offer a value proposition at this juncture. Okay. That's why I said at the beginning, my opinion about 2018 is to have a cautious approach in equity investments.
Fair enough. Okay, makes sense. The next one that you've picked out is the Hdfc Midcap Opportunities Fund. That's done really well. I think 35% in the last 1 year itself. What makes this particular midcap fund work for you?
So one, because it has been in existence for a long time. We've seen this fund basically living across all market cycles, and they have not lost. Well focused into what they want to pick. I mean, they're just not going with. They're experienced fund managers. Let's put it in one line. It's an experienced fund management which they've been incorporated with. The only concern that I have with this particular fund is the size of the fund. They're almost at about 20,000 crores.
Okay.
So that to a very small extent has one bit of caution in it. However, given the fund expertise and what the fund has done over different time horizons, I would put this into my bucket list because I don't want to miss out on the mid-cap opportunities again. I mean, we need to be participating in it.
Fair enough. Incidentally, this is one overlap fund between both our guests. So this one is something that both Feroze and Harshvardhan are sold on. I'm going to come to Feroze's list in just a second. Let's complete Harsh's. You also have the SBI Magnum Multi-Cap and the Birla Sun Life Tax Relief.
That's correct.
Again, rationale for these two funds.
Okay, so when we look at the SBI multi-cap, I mean, considering where we are standing today and again a cautious approach to equity investing, we see the multi-cap funds even today having a large exposure towards large cap funds. So they're anyways tilted towards large cap. So if you notice, this portfolio has a huge inclination towards large cap investing, and that is what the motto is going in 2018.
Okay, so that, and then the tax relief, the Birla Sun Life.
Of course. So we are at the fag end of the financial year as well, and we're going to see a lot of investments into the ELSS category. Now this fund is actually a multi-cap again, and has a superb track record.
Phenomenal return last 1 year, about 38-39%.
Absolutely.
Yeah.
So in case you're looking at a tax saving instrument, I mean, it's better to look at something which aligns with your long-term goals. So if you're having any investment oriented products which are like 10 or 15 years in nature, you'd rather go on with an ELSS scheme.
Sure.
Because that also aligns with your long-term goals.
Okay, so that is Harshvardhan's top 5 funds for 2018. We've got 5 more from Feroze as well. Feroze, so let's go over your approach, and it's quite beautiful because, we have one of you who's slightly more conservative. So for our conservative viewers, those are some ideas they can perhaps work with. And Feroze here, who's saying that maybe, you can still make a good amount of money this year in mid-cap funds. So what are your top mid-cap ideas then?
See, like Harsh mentioned, of course, there is some degree of euphoria which is already behind us. But the mid-cap, one thing which we have to very clearly remember is that SEBI came out with a regulation, right? That regulation is actually bringing conservatism in most of the mid-cap funds automatically. Okay. If I double do risk mitigation, then I hamper return, which is actually going to increase risk.
Sure.
Okay, so I'll explain what I'm trying to get to, is that SEBI has actually asked mid-cap funds and small-cap funds to consolidate to largely to the top 100, 300-400 companies in the country.
Yes.
Right? By stretch of imagination, a country of this size, skewing large values into these 300-400 is already being very conservative.
Yeah.
Now, if I bring large-cap funds into the portfolio, then my mid-cap exposure is even more.
Further,
so you're double doing the risk.
Yeah.
Coming back to what are the mid-cap funds, to cut this long story short, Canara Robeco Emerging Equities is a good mid-cap fund, and Hdfc mid-cap opportunities where there's an intersection with what Harsh is saying. These are two good mid-cap stocks, mid-cap funds which I think have a good stock picking capability on both the fund management side, which is the most important attribute of fund manager in the mid-cap space.
Okay, so those are the two mid-cap ideas. You also, of course, have the Birla Sun Life Equity Fund, which is I guess diversified equity?
It is diversified equity, and it tries to generate alpha. There's a Birla Frontline, which was recommended last year. This is Birla Equity, which is a little more dynamic, and I think that's the need of the hour. As long as you don't be static, and if you leave more discretion to the fund manager, you will be safer and still have an expected return greater than what. So it's more or less an actively managed large cap fund.
Okay, and two more, the Kotak Select Focus, which you've been very consistently recommending that fund for a while now. And the Mirai Asset India Opportunities Fund. So what's working in their favor?
See, what happens is Anand Rathi's method of choosing is not on the basis of past performance. Statistically, there's a measure to indicate future performance, better indicate, not completely indicate. So if you use a method called regression, which throws up schemes much before they start performing, and Kotak Select Focus has been recommended using that method is why it's a little, and then performances have been stupendous post facto. So, so both these schemes, in our opinion, have a future prospect greater than the past one. So I would continue to recommend them for the last 3-4 years. So that's why it's consistently been there in the recommendation.
Show where you can find out where the money is moving in 2018 and what your best personal finance bets could be like. So we've just finished discussing a whole host of interesting equity funds for the year ahead. Now, Feroze, let's come down to debt, because that number is still stuck in my head. You're saying if the benchmark bond yield goes up to 7.5%, I could perhaps make as much as 9 to 9.5% in debt funds. And if I stay invested for 3 years,
Correct.
then technically this should, become almost tax-free.
Correct.
So which are these funds?
See, of course, if the yields go to 7.5, my best picks would be some dynamic bond funds. The dynamic bond funds will benefit from the yield coming back down, because the long-term trend of the yield over 3 years, which becomes your minimum time frame because of the tax change which was there a couple of years back. So you don't have agility in the debt side at all. So 3-year time frames, if you look at 3 years, then you would not make 9.5. About 8.5, 9 is possible for 3 consecutive years compounded. So I would choose the dynamic bond funds, 2 dynamic bond funds. You can look at a Birla dynamic bond fund, and Hdfc's dynamic bond fund would be good bond funds to buy when yields go to 7.5.
And you can typically stay invested for 3 years to enjoy the tax advantage. But okay, then you don't make 9.5, but maybe at least 8.5.
Yeah, and if you buy a dynamic bond fund, most of the categories are infructuous after this tax change. So dynamic bond fund is the only fund which you can buy, because the rest of them you will never be able to get out and get in. So as the name suggests, dynamism is at the discretion of the fund manager, because you are tied up because of tax. So after this tax change, a person should just stick to dynamic bond funds if he or she has to take the benefit of interest.
Now, if I don't look at the next 3 years, if I'm looking at a debt mutual fund for the next 1 year, if I leave aside the taxation benefits, the indexation benefits, then what's a good fund to be in?
See, then I would choose a Franklin Dynamic Accrual Fund, which at least benefits from the higher interest rate certain corporates give. If you are a retail person and you are investing in a fund, then you would rely on Santosh Kamath's judgment, who is the fund manager or the CIO on the debt side, to get us corporates which give us the 2-3% extra interest. So I would choose a Franklin Dynamic Accrual Fund on the accrual side for a year. And if you are in the lower tax bracket, and then this whole 3-year thing is not relevant to you. And if you are in the higher tax bracket, you can look at a dynamic bond fund.
So if you're looking at the dynamic accrual fund, then what's the kind of expected return you can hope for?
9 to 9.25.
For the next 1 year. Okay, that would be quite phenomenal. Now, gentlemen, coming down to some, final thoughts as we're looking at the year ahead. Quick word on insurance. I mean, not that it changes with the change of the calendar year, but any specific products that came to your mind in 2017? Anything that might change in 2018? A word maybe on ULIPs, if at all they should be considered this year?
So, well, when it comes to insurance, the portfolio definitely has to comprise of a couple of products. The first being, of course, a life cover in the form of a term plan. So, we need not talk much about it, because everybody's kind of understood the importance of having a term plan. What needs attention is the medical cover. I mean, we're going to see the cost of medical treatment going up and up. So, what is important is that you have an adequate medical cover. Now, this needs to be really focused upon and given attention to. We've seen people having a medical cover, and which could be just about 3 lakhs or 5 lakhs, and that is not going to be sufficient. So, from a very concentrated advice, look at your medical portfolio in more detail, and please make sure that you have an adequate medical cover.
Absolutely, well taken, point well taken. Feroze, final thoughts?
Yeah, I think the asset allocation, if I had to summarize of how I would put it across for 2018, largely should be equity. If these are long-term goals, at least 60-70% should be equity. You have to look at risk mitigants to be able to take care of the bull run. Debt, be a little more agile, be more vigilant. So on the debt side, you will make money, provided you keep an eye. On real estate, it's a complete no-no.
Okay.
It will continue to be a no-no because it's a structural change, and people will lose a lot of time, if not money, not making money. So that's not, the time-wise correction could be 2, 3, 4 years. That's the opinion. And gold, I don't think should be an asset class. My only last thought would be, don't get distracted with things like bitcoins and stuff, because those are fundamentally incorrect principles on which they work.
Okay.
You're using a currency as an asset. It's like selling a 2,000 rupee note for 5,000 rupees. It's not fundamentally right. And from an insurance standpoint, of course, we should definitely review the insurance, which, like Harsh said, it's very, very important. We are underinsured, we are overexposed to real estate and overexposed to fixed deposit, and that should change hopefully as a resolution for 2018.
Fantastic, gentlemen. Thank you so much for your time. Thanks for joining in. We wish you a very, very sort of happy end to 2017 and a prosperous, wonderful new year as well. Thank you for joining in. And it's a very happy new year to all our viewers as well. Keep it simple, keep it safe, keep it steady, keep track of your finances. And of course, we will be here to take you through the ride all through 2018. This is Money, Money, Money. Thank you for watching.